Welcome to another edition of What the F Just Happened. This is Eric Dubin along with Dave Kranzler, and we're recording on August 7th. It's been a while since we have recorded a show, and we need to catch up on what's going on with gold, as well as some pretty interesting moves in Tesla that speak to just how artificial the markets are in the United States equity market. We'll address Tesla at the back end of the show. But when it comes to what's going on with gold, the continuation of short selling by hedge funds as the bag holders for the bullion banks, when the Comex is used as a price controlling mechanism, is the main theme that we've seen. We've seen gold drop further than we were expecting. U.S. equity markets are rising, and Dave and I have been making the argument that we've had global credit stress within the credit markets worldwide, and that explains why U.S. denominated assets have been going up. What do you think's going on now with the price of gold and what hedge funds are doing with their positions on the Comex, Dave?
Well, I still rest on my theory that what's going on right now with the price of gold is very similar to what was going on with the price of gold in 2008 when the price was taken down between March and the end of October from 1,020 is roughly where it peaked out in late March, and then they took it all the way down to 700. I think it even traded below 700 on an intraday basis. And I think the reason why they're taking down the price of gold at this point is because I think there's financial disaster brewing in the global and U.S. financial system. And I'm sure there's not much they can do about it, but the insider elitists are doing what they can to get ready and protect themselves. And they don't want gold alerting the world that there's a problem. So what do? You push down the price of gold and defuse the alarm mechanism that gold traditionally functions as. So, and in this latest takedown that we've seen since, I don't know, June or something like that, the price takedown, it's been a result of the hedge funds piling on. Now, the hedge funds have amassed a record short interest, both outright and on a net basis, net of their longs in Comex paper gold. And the hedge funds actually, going short, the hedge fund algos shorting gold like this is really, it didn't really start happening until, really 2015. I'm looking at numbers that go all the way back to 2006, and hedge funds didn't run net short position. This is the managed money account, which is primarily the hedge funds. Hedge funds never went net short gold until it was actually the July 21st COT report where they first showed up shorting. And I think what happened is with the advent of hedge fund algo trading, the banks would start pushing down the price of gold and build up their net short position, and then the hedge funds would take over and start chasing it even lower. And for the last couple of years, when the hedge funds get short gold, it usually marks a bottoming process. So in a sense, the hedge funds have sort of been engineered into doing the dirty work for the banks. So the banks don't even the banks can say, look, we're covering our shorts here. We're not responsible for this latest price takedown. It's the hedge funds that are pushing it lower, and that's what's been happening. So regardless of the methodology, I think that in a freely trading market where you couldn't issue paper gold in excess of the amount of underlying gold that you have available to deliver into your futures or LBMA forward position, I think that the price of gold would be much higher. And it would also, be sending the world a very bearish signal. So that's what I think is going on with the price of gold here.
When we layer on top of that analysis what's going on with the global macro picture and the U.S. dollar and how that will impact the price of gold, the U.S. dollar started rising from lows below 90 on the DXY midway through April, and it's been moving relatively sideways for the last month and a half or so. But that was a big move that corresponded directly with gold beginning to fall, and hedge fund shorts respond more so to the cross of dollar gold than any other signal. And we see the momentum for a rising dollar occurring when there are counterintuitive, traditional economic factors that point to a U.S. economy weakening, the inversion of the yield curve suggesting that a recession is not too far out in the future. We have talk about trade wars, which is obviously not good for the U.S. economy. There's every reason to believe that we are 10 years into this artificial rebound from the 2000 March low in the financial markets and the economic crash that resulted from the financial market crash, that this economic recovery is long in the tooth and that we're staring down a recession. But at the exact same time, we're seeing global capital flows rush into the dollar. And this speaks to stresses within the credit markets. Even earlier this year, when Deutsche Bank took a bath, if you look at the ADR price for our listeners, and if they wish, they can pull up a chart by the ticker symbol DB. You can see that it was above 20 and it crashed to 10 and change as people were fearful of the credit default swap exposure that Deutsche Bank embodies rolling over, that there's very significant stresses within the credit markets worldwide. And I believe that what we're seeing is a rush into the perception of the dollar as being a safe haven asset, as well as U.S.-based equities denominated in dollars to park capital. We live in a world with $6 trillion of notional monies flying around in the FX market on an intraday basis. It's a gigantic pool of capital, and the dollar has been driving gold. And there's an operating theory by many people within the precious metals community that believes that the yuan is having a big direct impact on the price of gold, with the devaluation of the yuan occurring with gold going down. We've seen counter correlation to that dynamic in the past, where the yuan would devalue and gold would go up. So, there's a lot going on, but the primary driver of the U.S. dollar moving up now, I believe, is more a reflection of increasing strains within the global credit market, and that the traditional correlation of a rising dollar putting pressure on the price of gold is really what's operative here, more so than any notion of the coincidence of a correlation of the yuan declining in value and gold going down.
Yeah, I mean, certainly there's been a correlation between gold gold going down in dollar terms and the yuan going down in dollar terms. Okay, so so both of those charts have been moving in tandem for about 3 months now. That doesn't mean that they share a common causality here, other than the fact that they're both going down against the dollar. I mean, we know that the hedge funds trading on the Comex have been driving the dollar price of gold down by shorting an enormous amount of paper gold futures. And I just looked at my spreadsheets, and the hedge funds went net short gold as of the end of June commitment of traders report, but they were net long 132,000 gold contracts as recently as mid-April, and they've been dumping their longs and shorting gold ever since then, and they finally went negative in late June. So, and now they're more short, and now they're record short. So we know that the dollar price of gold is being driven down in the paper gold market on the Comex. And we know that the yuan is going down versus the dollar, and I read a commentary from someone maybe about a week ago, and I wish I had saved it. I don't remember who it was, but this guy pointed out that China's currently running a trade deficit now with Europe and Japan, and so they've been devaluing the yuan versus the euro and the yen, and so part of that collateral damage is the yuan's going down versus the dollar, and that's a twofold purpose. They're making an attempt to balance out their balance of trade with Europe and Japan, but it also driving the yuan down versus the dollar is an answer to Trump and his trade war. It's basically a unilateral trade war. So, the fact that gold is going down and the yuan is going down, both priced in dollars, only tells us that both are going down priced in dollars. There's no evidence whatsoever that China is trying to use the yuan to control the price of gold. To me, the two events are happening independently. When two things have a positive correlation, all it says is that they've moved together and absolutely nothing more. It's not evidence that a cause and effect relationship exists between the two and that it will continue into the future. Now, maybe it will. I don't know. I'm not saying that the Chinese haven't tried to peg the price of gold to the yuan, but I just haven't seen any arguments out there or any evidence that that's the case, or any arguments supporting reasons, good reasons why the Chinese would want to peg gold and peg gold to the yuan right now. Have you?
No, and I don't believe that that's their official or unofficial policy as well. And the two biggest flies in the ointment of the argument that there is a direct correlation here that actually is implying causation is that we've seen the inverse of that correlation in the past. And there's also the fact that the Chinese yuan has a managed peg regime against its trading vis-a-vis the US dollar, which means that there's an auto correlation to a large extent between the two currencies. And the policy regime governing how the Chinese look at the yuan takes into consideration a whole heck of a lot more than just how they might perceive the price of gold. Their primary concerns are what happens with their capital markets and flows with credit within their system. Just within the last week, we've seen the Chinese central bank put pressure on 14 banks to raise their reserve requirements so as to suck in more of capital to purchase yuan, so as to have, to explain this to our listeners, when the reserve requirements go up, these 14 banks have to go out into the market to acquire more yuan, and that supports the currency, and that put a stop to this really fast rush where we've seen more than a 2% devaluation of the yuan vis-a-vis the US dollar, as speculators have been losing confidence in the yuan vis-a-vis the dollar. And the move was so fast that we almost went to 7 versus $1 in the global exchange markets. And that was being driven by the offshore yuan dollar currency market. So they went to the banks and put pressure on them, and their policy is to try to control the general trading of the yuan vis-a-vis the dollar, even though they make a lot of noise within the media about how they don't do that. But they clearly do. Actions speak louder than words, and when they tighten the screws on these 14 banks, it speaks for itself, trying to get the reserve requirements up so as to stop the valuation of the yuan vis-a-vis the dollar. These are the bigger picture dynamics that the policymakers in China consider when they decide just how they'd like to see the yuan trade vis-a-vis world currencies. Their primary concern is not the price of gold and trying to manipulate it. No. Their primary concerns are focused on what the heck is going on with an overextended credit system in China, where malinvestment and the extent to which the economy is overextended is front and center, and they're trying to maintain economic development so as to prevent pitchforks in the street. So, Dave, while we missed the bottom, thinking that 12.35.38 on price of gold was going to continue to be the point where we'd see bounces, we've lost another 20 some odd dollars in gold. The seasonal trends of July marking a bottom, and the fact that gold really hasn't completely fallen apart, even though bullion banks and forces that would like to see gold all the more lower while the dollar has been going sideways. And time will tell, but we both still maintain that, gold's not going to roll over and just die. There's huge underpinning support for physical demand in Asia, and we're not in a bear market in gold. And even if the dollar rose a bit more, we probably will see gold bouncing off of 1,200. When we look at the whole question of what's going on in our financial markets and the opacity, there's no better poster child that we can turn to than the comedy of Tesla.
First, I want to circle back really quickly because I'm not conceding that we missed the bottom. I mean, with futures, pegging a bottom is horseshoes and hand grenades. I mean, I've always said, and I write this in my mining stock journal, that anything can happen over a short-term basis. You know, if a hedge fund or a bullion bank chucks enough paper gold into the market on a Friday, they can push the price down $20, $30 in a matter of seconds. So, you know, to say that, you know, maybe the 1200 to 1230 area is a bottom, I mean, that's really how you need to collar a bottom area. I mean, if we went down to 1150 and stayed there for a month, then I'd say, yeah, I guess we missed the bottom. Historically, July's been the lowest seasonal month for Indian and Chinese gold buying. The Chinese have been pretty dormant this month, although their gold buying in July is up quite a bit over July of 2017. And the Indians have actually been buying quite a bit of gold, especially now that they're importing doré bars instead of kilo bars. It makes it cheaper for Indians to import doré bars and refine them in India than it does to import the pre-refined bars. But so at any rate, you know, I'm not conceding that we missed the bottom. We haven't missed the bottom yet. You know, did we miss it exactly? Sure, but no one, you know, anyone who says they picked the bottom in something like gold or any futures product is lying.
It's more important to get the general trends right and to point to a bigger picture of a phase shift underway. If gold is trading at 1150 for a month, as you cite, that's cause to second guess the rationale that we are in a bottoming process.
Yeah, $20 is not a lot lower when you're talking about, you know, a $1,200
exactly.
item.
It's 1.6%. It's a rounding error when you deal with an asset as volatile as the price of gold.
Right. What went on today has just made a complete and absolute mockery of U.S. financial and capital markets. And the fact that the NASDAQ and the SEC are letting this persist is, you know, it's just emblematic of the fact that there's no rule of law left in this country. I mean, I think this is the last ditch act of a madman to try and give his company credibility and keep the stock price up. If you look at if you dissect his second quarter financials, which I've done to some extent, and I actually discovered a way in which he kept he deferred cash spending in the quarter to make it look like he had more cash, but it's going to be cash that he's going to have to spend if he expects to sell those gated cars. And he has negative working capital when you net everything out, including what he says is his availability under his revolver. But to think that the idea that someone's going to fund an $82 billion buyout of this company is absurd. I mean, it's just the most ridiculous thing I've ever heard. I mean, even if you said, you know, okay, well, he owns 20% of the company, so at 82 billion, that's 16 billion. So he only needs to come up with 66 billion. Well, no one's going to lend 66 billion to this thing. And I can't imagine that even if you said that someone would step up and lend 40 billion of it, which in and of itself is an absurd notion, who's going to lend the, you know, what is it, another 24, 25 billion in cash equity? I mean, this company is throwing off negative cash flow. You don't do a leverage buyout on a company that has negative cash flow, because once the debt's issued, it has to start being serviced immediately. So even if you said, okay, well, he's put together a deal that includes 40 billion in debt, you're probably looking at about somewhere between an 8 and 10% interest rate on that debt. So you're looking at, you know, 3.5 billion in interest expense right out of the gate on an annual basis. Where's he going to get the cash to pay for that? I'm sorry, but there's no way anyone would finance a negative cash flow company with these assets that are already leveraged up. Some of the assets, I've know some people who think that, you know, some of these assets have been hypothecated. You know, if you look at their auto lease funding program, Deutsche Bank's the trustee. I mean, Deutsche Bank's more corrupt than JP Morgan. And we know JP Morgan was hypothecating assets in the MF Global ordeal. So, and they didn't get punished for that. So, why wouldn't Deutsche Bank, take fees for hypothecating Tesla's assets, to help Tesla raise, more funding? It's big fees for Deutsche Bank. But anyway, all that aside, just the fact that he can go onto Twitter and say that he's got a 420 share deal with financing already secured is just the most absurd notion. And then the NASDAQ halts the stock, gets a statement from the company that, yes, Elon Musk is considering taking the company private. Well, let's see evidence of the fact that you've got funding even available. I mean, the fact that he pre-announced that on a venue like Twitter 20 years ago, that would have been illegal. Musk would have been shut down at this point by the SEC. I'm not saying the company would have been, but Musk would have been. I mean, this just makes a complete mockery of our equity markets, our legal system, and the entire U.S. financial system. It's absurd.
They sell, 126 some odd thousand cars on a 12-month trailing basis, and they have a valuation that's as big as Volkswagen at $83 billion, give or take, and with this buyout offer that Tesla is floating. And
it's not even Tesla floating it. Musk is floating it.
Yeah. No, it's basically a propaganda effort on his part. The only reason why the stock is where it is right now is because there's just been a whole lot of momentum and people looking to bank on 10 years of forward growth of Tesla being the next greatest thing in the auto industry.
Tesla's products are about ready to get squashed by 4 or 5 of the largest automakers in the world who are going to be rolling out competing products. And right. No one's going to buy a Tesla when you start seeing what Audi has, what Jaguar has, what Porsche has, what some of the Japanese automakers are going to start rolling out. And Tesla's going to be a non-event. No one would lend money to this company to do a buyout like that.
And normally when you'd have an LBO this big, you'd have the investors behind it saying something in the media too.
I think the only way you can summarize this situation is that it makes a complete mockery of U.S. capital markets and has rendered the U.S. stock market a complete joke.
Well, on that note, I think it's a pretty good place to wrap. This has been the latest edition of What the F Just Happened with Dave Kranzler and myself, Eric Dubin. This show is brought to you in part by Wall Street from Main Street, and you can check out their productions by clicking on the Wall Street from Main Street link under the YouTube player. Thanks for listening, and if you'd like to check out Dave's analysis about Tesla and more, you can find his free blog posts over at investmentresearchdynamics.com, and you can follow my work over at facebook.com/Eric Dubin. Thanks for listening.